In this video, we discussed stocks. Previously, we discussed bonds. It applied to time value of money. Bonds are simple, regular instruments. A bond's cash flows are easily identifiable and do not change, at least for fixed-rate bonds. Determining the present value of the stream of coupon interest payments and adding the present value of the bond's face amount at maturity are all you need to do. Stock valuation is very different. There is not one valuation method, but many. Valuation approaches can be fundamental. For example, discounting a stock's cash flow, or relative. For example, comparing the subject company to industry bellwethers or leaders using a common financial metric. There are many cash flows that can be discounted, and many common metrics are usable, so valuing stock is anything but uniform. If stock valuation is so subjective, then why invest time in learning it? The best answer is stocks provide some of the best returns to investors over the long term. There are trade-offs for stocks' high rates of returns. Stocks are liquid investments and can be bought or sold in secondary markets easily. Information about companies, markets, and important trends are widely available to investors. The negatives would include general risks are greater than with bonds or other fixed income investments, when to buy and when to sell are difficult decisions, and dividends, if they are paid, are uncertain and subject to change. Note that we have already discussed the intrinsic or fundamental valuation and relative valuation. A third approach, called technical analysis, is not a valuation method per se, but is often used to provide insights into buy, sell, or hold decisions about stock. Valuation using the price-earnings ratio is where you take the price per share divided by the earnings per share. First, you calculate the earnings per share as net income divided by shares outstanding. Secondly, determine the price to earnings ratio for your respective industry, and then calculate the share price. We rearrange the terms and solve for the price per share, where the price per share will equal the earnings per share from the first step multiplied by the second step's PE ratio. The price-to-book ratio calculates a company's current market value relative to its book value. Similarly, the price-to-book uses an industry benchmark and multiplies it by the book value of the firm, as demonstrated in the step-by-step process below and the final formula. A commonly used valuation method is relative valuation. A target company is compared with other companies in the same industry in terms of a particular financial ratio. The approach assumes the target follows a similar relationship between the common metric and the metric's value. The text uses the PE ratio to do this. You identify the PE ratio for the target company's industry, calculate the target company's earnings per share, and multiply the target company's earnings per share by the industry's PE ratio, resulting in a company value. Once you solve for the price per share, you have a relative valuation of the target's company share. You can refine this further if you wish. If the target company is considered among the best companies in the industry, the PE might be adjusted higher. Likewise, the target company underperforms industry peers might warrant a lower PE. The PE multiple may easily be the most common metric used for relative valuation and for assessing a company's performance in general. But what does it mean? And what are its uses other than valuation? The PE is a ratio or a multiple. As shown in the ratio above, it is calculated by dividing the current stock price by the company's earnings per share. The interpretation is it tells you how many years of company earnings you are buying at the current stock price. This concept is probably too abstruse for some of you, but literally reading the PE ratio, a conceptual reductive approach is probably better. The higher the PE, the more positive investors feel about the company. A PE of 25 indicates investors are willing to pay for 25 years of company earnings. A PE of 15 means investors are willing to buy only 15 years. More bullish investors will buy more years of earnings, so the PE can be thought of as an investor's confidence index. Note that the PE is not denominated in any units, such as dollars, miles per gallon, BTUs, etc. It is at its core a measure of investor attractiveness. Another one is the PB ratio. This one's not a valuation per se, but a tool to arrive at a valuation. Where terms are rearranged, it solves for stock price or market cap. The method determines how much the market or investors think the company is worth, the market price, compared with what the company's accounts show as value, book value. An interpretation of the price-to-book ratio itself would be how much more does the market think the company is worth compared to what the company shows as its equity value. The meaning of a high or low PB is left open for the analyst to decide. Other valuation models listed in text include EV or enterprise value models. These became popular in the 1980s as a measure of what a company would be worth as an acquisition target. The 1980s were a period of very active acquisitions, many of which were hostile. If the acquirer wants to buy a target company, it would need to purchase its share of market value plus absorb its net debt. It is a more realistic measure of the value of a target company. The dividend discount model, or DDM, is a stock valuation method based on the concept that a share's worth is the present value of all the future dividends it pays. Note, it assumes that a company pays dividends. There are many forms depending on assumptions made about the company and the future dividends it pays. These include the Gordon growth model, zero growth model, constant growth model, variable or non-constant growth model, two-stage model. We take an altogether different approach to valuation than the relative valuations. Relative valuation ignores details about a company's operating performance and uses the benchmark financial ratio to quickly calculate value. DCF, or discounted cash flow models, get inside the company to see how well it performs in order to value it. An old cliche in business and finance is cash is king. That is the spirit of the DCF valuation. After the stock market crashed in 1929, it became apparent that too many investors relied on little or faulty information to make investment decisions. Naive investors were aided and abetted by some unscrupulous securities promoters. Something had to be done to help the average investor. The fundamental analysts in the 1930s came into play. These new investors spelled out better ways to invest than listening to your neighbor over the fence. The underlying principle was to identify cash flow and value that. In 1938, John Burr Williams wrote his classic financial text, The Theory of Investment Value. He put forward the dividend discount model. Dividend payments are real, identifiable cash, and that's the basis for stock's value according to Williams. Note, companies pay more dividends than they do now. The original model was a simple perpetuity of the form stock value equals annual dividends divided by the required rate of return. Several years later, Myron Gordon revised the model to incorporate growth. If the company is growing by G%, then it's reasonable to expect dividends to grow by approximately G%. So the stock value would be equal to the dividend paid next period divided by R minus G. Other growth scenarios were subsequently modeled to include more than one rate of growth. Examples are worked out in the text. DDM stands for discounted dividend models. These are based on a stock's periodic dividends. This focuses on a company's cash flows, determine the present value of the entire organization, and then allocate cash flows to total shares outstanding of the subject company. It is a fundamental and highly regarded method of valuation due to its use of meticulous analysis of company operations as reflected in its financial statements. It does not take a shortcut. The general form is described in the equation below. The stock value equals cash flow over each period in time divided by 1 plus the interest rate raised to whatever period in time, plus finally terminal cash flow divided by R minus G, all divided by 1 plus R raised to the n minus 1. The DCF model is an absolute valuation model, meaning it doesn't involve comparisons with other firms within any specific industry, but instead uses subjective data to evaluate a company on a standalone basis. Thus, we focus on the company's future cash flows. We can use Excel to value our solutions or a calculator. Note that substantial work is required to determine the actual cash flows are discounted. This is a very rigorous process. Preferred stock is a form of equity sold by some firms that offers preferential claims and ownership. It features a dividend that a company is obligated to pay before any dividend payments to common stockholders. In the case of bankruptcy or liquidation, preferred stockholders have priority claim to assets before common stockholders, but they do not have priority claim to bondholders. Preferred stockholders are usually entitled to a set or constant dividend every period. Preferred stock has characteristics of both debt and equity and is commonly thought of as a hybrid. Preferred comes from the superior position preferred stock holds vis-a-vis common share. Although not always paid, preferred stock dividends are paid by the company before any common dividends are paid. The dividend payout scheme is set at stock issuance as a fixed percentage of the stock's par value. In liquidation, if necessary, preferred shareholders are paid out before common shareholders. Finally, and often most importantly, preferred shares normally give greater voting rights than common shares, usually a multiple of the number of shares. Company founders who are still active with the company frequently issue preferred shares with super voting rights to themselves. This enables these shareholders to control the company even though they have minority ownership. The valuation of preferred stock is comparable to a perpetuity. The stock value is equal to the dividend divided by the discount rate. The discount rate is normally a company's WACC, or weighted average cost of capital. For investors to feel confident they participate in a market that is fair and timely, the market must satisfy two fundamental characteristics: efficiency from both the operational and informational perspective. The market will operate optimally in these conditions. This has been studied for decades, and efforts to ensure efficiency are ongoing. Operational efficiency means that the mechanics of the market allow buyers and sellers to execute their orders quickly and accurately. They continue to evolve as technology evolves. Informational efficiency describes how much and how relevant information about companies, markets, and economics is processed by investors. The EMH, or efficient market hypothesis, is one of the most famous and strongly held theories in finance, while also being one of the most contested. The origin of the hypothesis traces back over 100 years to the work of Louis Bachelier and has been researched by luminaries including Benoit Mandelbrot and Paul Samuelson, reaching its height with Eugene Fama in the 1970s. The hypothesis, as stated by Mandelbrot, is, roughly speaking, a competitive market of securities, commodities, or bonds that may be considered efficient if every price already reflects all the relevant information that's available. The arrival of new information causes imperfection, but it is assumed that every such imperfection is promptly arbitraged away. In other words, in an efficient market, at any given time, a security is priced with the right price because all available information about the security is available in the market and a wealth of analysts use this information. So price anomalies should be arbitraged away pretty quickly. An important conclusion coming from the EMH can be somewhat quite confusing. If the market is efficient, then stock returns reflect their beta risk, and so investors can buy and hold a portfolio reflecting their risk appetite. Looking for returns not reflected in beta is pointless. This brings up the issue of active versus passive investing. You may want to consider learning more about the basis of investing. The EMH has been reconsidered because of the many periods when asset prices seem to have been mispriced. For example, the tech stock bubble of 2001, real estate prices of the late 2000s, the flash crash of 2010, and many other market events that seem to indicate market values can be dislodged from their real values. Breakthrough research that called into question the market's rationality and efficiency came in 1979 from Daniel Kahneman and Amos Tversky. Abandoning the assumption of an efficient, rational market, the authors threw open the doors to an alternative approach called prospect theory. Behavioral finance was born. Thanks for watching and listening. Be sure to like and subscribe.